12, 11, 18, implied vol, expected move. Okay? So, David, we're going to use you as our guinea pig. It does. The straddle price already has the vol calculated in, but let's go further. Okay, let's go further. Okay, give me a stock you want to look at, David, whether it's CGC or another one. Since you brought this up, any random stock. Okay. So let's go. Let's not look at this week, just because there's only essentially 3 days left. But let's look at the implied vol of next week. Okay? And the implied vol really isn't that different between this week and next week. Okay, but if we look at implied vol, would you all agree that we're right about 72%, 73%, somewhere right in there? Right? Okay. Stock equals 32.25 and implied vol 72%. So mathematically, the definition of that means if I take the current stock price, 32.25, I multiply that by the current IV. That gives me $23.22. So what the market is pricing in right now, that $23.22, the market is pricing in that this stock within the next year will trade in the range of 32.25, where we are right now, plus or minus the $23.22 range. So the expected range is $9.03 up to $55.45. $55.47, sorry. That is what the market is saying, pricing in the expected move. Now, how does that relate to, how does that translate to what the straddle is trading? How do we know that that's expensive vol, less expensive vol? Okay, well, let's bring up our volatility chart here for a second. Okay, we look at 72%, and quite frankly, it's not all that high in CGC right now. It's actually pretty close to being in the middle of the range if you look at it. Would you guys agree? Anybody? Yes, no, maybe? No, not based on HV. Now we're only at IV. Okay, what would you say is the middle of the range? Okay, where would you say the middle of the range is? Okay, so we're somewhere Somewhere close. Yeah, probably is closer to 80. Right, Lionel, the middle of the two range. So if I actually bring this up on Thinkorswim to look at IV rank, which I'm going to do here in a second. Okay, IV rank is actually about 66%. So, close to being in the middle here. It's close to being in the middle. But here's why this makes a difference. Let's calculate the same expected range, the same expected move, if IV was down at the bottom here. Let's call it 60%. Okay? So if IV was 60%, the expected range would be, well, then we take 32.25 times 0.6, and that equals 1935. So now that range would be 1290 up to 5160 instead of 903 to 5547. Okay? So if implied vol was down at this range, thus leading to a tighter expected range over the next year, then logically, option prices should be less expensive. The straddle should be trading less, right? Does that make sense? Okay. Does that make sense to everyone? Okay, and then we can obviously do the math for the upside. Let's say vol was trading up here at 100%. Well, that's an easy calculation, but let's do it, at 95%. So it's not quite as easy. So if IV was 95%, then the expected range, or the expected move, is 32.25 times 0.95, which is 30.64. Now, that expected range is $1.61 all the way up to $62.89. Well, if that were the case, what do you think the price of the straddle would be? Would it be higher or lower? Right, it would be much higher. So there you go, in that it's reflected in the pricing of the options. Therefore, reflected in the expected move. Okay, does that make sense? Does that help out? Okay. Anybody have questions on that? Well, Russell, no worries. It's recorded. It'll be posted up here in the room shortly. Okay? Exactly, Robin, right? And doesn't that make sense? If something is predicted to be more volatile, then it should cost more. Yeah, that has nothing to do with this, Dimitri. That's something completely different. That was just for calculating the amount of premium in an expected move. All right, let me get this going here. Let me get the video rendered, and I'll put it up here in the room in a moment.